And in a fractional reserve banking system, which is the way banking systems operate, they never keep on hand as much cash in the vault as they do their deposit liabilities. So the bank may have $1 million of deposits for its customers, but maybe only $50,000 or $100,000 of cash in the vault because they've lent the rest out essentially. And so they make money by lending out their customer deposits and then getting the rate of return on those loans. Of course, the loans were going bad in the 30s because people didn't have the money to pay the loans back. Not just mortgages, but farm loans and car loans and everything else. So the banking system was collapsing. So people were running on these banks. The Fed basically ignored it. I'll talk about why in a minute. The Federal Reserve credit, I showed you the balance sheet of the Fed jumping up like this in 2008, didn't do that in the 30s. It basically stayed flat. In fact, it contracted at the beginning stage of the Depression. The monetary base, that is currency in circulation plus reserve deposits at the Fed, grew a little bit. The Fed supplied some cash to help accommodate the withdrawal demands of cash from banks. So the monetary base grew, but that wasn't nearly fast enough to keep the money supply from growing. And so here's the Fed's balance sheet in essence. So we have these financial panics, these shocks hitting the banking system, starting with the stock market crash, the banking panics. When Great Britain went off the gold standard in the fall of 1931, that caused speculation around the world that the US would be next to go off the gold standard. And that resulted in a lot of foreign withdrawals of gold from American banks. We were on the gold standard in those days. Dollars were convertible into gold. But if there was concern that we might go off the gold standard, then somebody who's holding dollars would not be able to get gold. And so there were foreigners were pulling dollars out of American banks, converting them into gold and getting them out of the country. And that was a shock that was hitting the banking system. So what happened is the Fed, the sum of the red portion here and the blue portion essentially is the amount of loans the Fed is making to the banking system plus the liquidity we're providing by buying securities, by buying government bonds. So when these shocks would occur, the Fed, increased their lending temporarily, but it would always shrink back down. In fact, it would often shrink back down to a level that was below where it had been before the shock. So on net, the Fed is actually contracting its balance sheet rather than expanding it. Now eventually, starting in 1931-32, the Fed starts to expand its balance sheet a bit, but it's very sluggish and not nearly enough to keep the money supply, which is the yellow line here, or the greenish yellow line, from collapsing, particularly following each of these shocks. So these vertical lines are those shocks I had on the previous, so it's just lining up the dates. The blue is the total Fed credit, that's our balance sheet. The red is the monetary base, and then the green is the money stock. So again, in the most recent episode, 2007, 2009, the money supply has continued to expand. Here, it's collapsing. And it's the falling money stock, the blue, which is explaining why the price level is falling, why we're having so much deflation in the economy. Now, it doesn't take a rocket scientist to understand that if you have a home loan and you're contracted to pay, say, $1,000 a month on your loan, principal and interest, and if your income is going down, it makes it a little tougher to pay that home loan, make that $1,000 payment. That's a classic debt deflation story. As prices are falling in the economy, as incomes are falling, it makes it harder to repay pay loans, which are fixed in a fixed dollar amount term. So that was a significant problem affecting households and businesses throughout the economy in the 30s. As prices were falling, as incomes were falling, it made it much more difficult to repay loans. And when the loans are not being repaid, that's less income for the lender, the banking system, so they're more apt to go out of business because they're failing right and left. So they've got, on the one side of their balance sheet, their loans are not being repaid, so they have no income, And the other side of the balance sheet, depositors are coming in and wanting to take their deposits out in the form of cash. So because of all of this, about a third of the banks in the U.S. economy failed. Again, no deposit insurance. Why wasn't the Fed more aggressive doing about this? Why were they asleep on the bench? Well, one reason is because the Fed officials were misinterpreting monetary conditions. It's not that they didn't see banks failing all around, but they just didn't quite get the idea of what they should do about it. One reason was because interest rates were very low. Not unlike today, they were very low. But that doesn't necessarily mean that monetary conditions are loose or easy. If there's deflation in the economy, if incomes are shrinking, prices are shrinking, it's making the real cost of borrowing, the real interest rate, go up rather than down. And so here's a picture of the nominal interest rate. I just picked a short-term interest rate on business rate, a banker's acceptance rate. So that fell to very low levels. You know, if a business, a AAA borrower or the U.S. government could borrow at 1% or less in 1931, 32, 33. But because of deflation, the real cost of borrowing, the real interest rate, was rising significantly. So deflation makes the pain, if you will, of having a debt increase. Even if the nominal borrowing rate is going down on new loans in the economy, because your income is shrinking so fast, despite a lower interest rate, it's just much more expensive to borrow in the sense of how much you have to work, how much you have to produce, how much income you have to have in order to repay those loans. Another reason the Federal Reserve Act limited the Fed's ability to help only to banks that were members of the Federal Reserve System. Now, since 1980, all banks, all savings loans, all credit unions have access to the Fed's discount window. The Fed can make emergency loans to any depository institution. But before 1980, the Fed could only make direct loans to its member banks, which tended to be the larger banks located in larger cities. They were in better condition generally than the small banks, the community banks that were out in the smaller areas, the rural areas. They were the ones that were collapsing at a high rate. So even to the extent that the Fed recognized the problem, they had a legal problem getting the cash out to the areas of the country that really needed it. And some people were concerned about speculation, financial speculation. Again, there's some parallels here with the current situation. We saw the big housing boom, the bubble in house prices, the subprime mortgages, people getting loans with no money down or not having to prove their income because banks were just throwing money at them. Okay? The same sort of stories were going on in the 20s, both about mortgages but also about the stock market. There was a lot of concern about speculation in Wall Street and that the Fed had been too loose in the 20s, put out too much money, and that caused the stock market run up. And a lot of people saw the collapse of the stock market as being an important cause of the Depression, if only because of the timing. The crash happened and then there was a depression. And I'm not saying there wasn't a connection, but a lot of people saw that as a very tight connection between financial speculation in the 20s and the subsequent depression. So in the 30s, there was a lot of concern about not wanting to reignite that sort of speculative frenzy. And so there were people within the Fed who were concerned about doing that and didn't want to put out money when they saw it as not being needed and likely only to be funneled into reinflating Wall Street and not helping Main Street. So again, it's honest disagreements about the efficacy of policy. Okay, so let's talk about lessons learned. Ben Bernanke, in a 90th anniversary party for Milton Friedman, the great monetarist economist who had written about the Great Depression, had really blamed the Fed for causing the Great Depression, for allowing the money supply to fall, to allowing the bank panics to happen. Ben Bernanke at Friedman's 90th birthday party said, we understand, Milton, you taught us. We've learned those lessons and we won't let it happen again. And if there's anything about Ben Bernanke's tenure as Fed chairman, it's that he's trying his damnedest not to let it happen again. And so the Fed has been much more aggressive about responding to shocks in the financial system and trying to keep the economy expanding.